Hello and welcome to Dialogue. While there has been positive growth in many sectors, recent data is showing signs that China's economic growth rate is experiencing a slowdown. What factors are behind this, and what sectors are most affected? And what can be done right now to stimulate the economy? To answer these questions and more, I'm joined by Professor Gong from the University of International Business and Economics, David Mahon, Executive Chairman at Mahon China Investment Management, and Qu Qiang, Research Fellow at Beijing Foreign Studies University. That's our topic. I'm Xu Qingduo. Welcome to Dialogue. Professor Qu Qiang, we'll start with you. How do you best characterize the current state of the Chinese economic growth? Optimists would say this is temporary, for those slower than expected growth because China is in the process of upgrading its, let's say, economic structure, shifting away from investment in infrastructure or real estate toward high-end industries. Pessimists would say this indicates something worse will come off. What do you make of that?
Well, long story short, I would like to say China's economy right now is shifting gears and try to restructure in the uncertain weather. So what we say that is because on one hand, you've been seeing that Chinese economy still maintaining 5.5% of the growth speed, which is amazing, especially against the current uncertain domestic and the foreign economic atmosphere. Especially a lot of people saying in the past, Chinese economy is too much driven by the debt. But nowadays, you see the property market and the debt market is slowing down, but Chinese economy still are resilient, and you have to give that something, right? And also, secondly, you've been seeing that Chinese high-end or high-tech manufacturing equipment industry are seeing exponential growth, no matter in domestic sales or in export. So it shows Chinese economy are shifting gears and restructuring. And also Chinese hospitality industry, service industry is not only recovering, I would like to say it's overheating. Just go to Beijing, Shanghai, go to Chengdu, you see there are people everywhere in a tourism resort. So I think one thing that Chinese economy is really getting better and better, but also another thing is for the long-term expenditure, especially in the property market, people are trying to reconsider for a while. And also in the debt market, the government are paying extra attention, trying to solve the systematic risks. So I think, yes, against uncertain global weather and economy, I think China is trying its best to optimize its structure, try to weather through this uncertainty.
Mm-hmm. There's a bit mixed in terms of the overall picture there. John, I mean, just as Qu Qiang said, if you look at the box office, if you look at the tourism, and if you look at transportation, you do see a strong rebound of the economy. That's this service, at least in service sector. Other sectors, not that satisfactory, probably lower than expected. So, what do you see in the Chinese economy, in July and probably in the current sector, in the current quarter?
Well, it's a good way to look at the economy from a sectoral perspective. We understand that the real estate property market is experiencing huge problems. The export sector is experiencing some challenges, and in some areas of manufacturing, things are also slowing down. Now, as you said, the service sectors are doing great, but I think from a sort of more fundamental point of view, I think the more important problem, the more underlying problem, is really lack of aggregate demand, mostly constrained by income. Particularly income associated with low-income group people. I think this strata of the society still haven't recovered from the COVID era yet. In terms of their jobs, in terms of their income, in terms of their capacity to spend. I think that you look at the unemployment figure, for example, it is still quite high, among certain segments of the society. I think these are the areas where are the areas that are dragging us down, and then you help. So I'm still a strong believer in fiscal policy, trying to stimulate the economy in terms of more expenditures from the government, and hopefully these expenditures would be percolating down to that segment of the society, so that these people would have adequate income to spend. This is I think a more fundamental problem. So in other words, I look at a slew of policies that have been coming from several ministries, branches of the government. I think overall, they're very encouraging to see. It's very encouraging to see these policy measures. But I think in terms of the real money, capital injected into the economy, my view is that it's still not adequate. I think we need to see some real stimulus packages from the government in terms of real capital expenditures on certain sectors and certain projects to jumpstart the economy. We are in a Otherwise we are in a sort of a spiraling down situation. You know, Investors are making these decisions based on macro aggregate numbers. If the numbers are showing weakness, people are going to hold back. So I think it's time for the government to step in. China's overall debt level is still quite modest, in my view, as a percentage of GDP. There's still a lot of room for government borrowing and for the fiscal purposes.
Yeah, fiscal policies there. David, if you look at this global economy, fewer bright spots, let's say, due to a variety of factors. And if you look at the growth rate, of course, despite being slowing down, the Chinese economy is still growing rather fast. So what do you make of that, especially comparing the Chinese economy and the rest of the world?
I think the Chinese economy fundamentally is strong, but because of the shock of the closed COVID years, and also the manner in which zero COVID was implemented and then suddenly ended, the consumers, I think, are concerned. I think there was a level of caution, and this, of course, means that they're not spending. They'll go on holiday, and I'm myself in Hangzhou on a business trip, but the railway stations are full, the airports are full. People are really using this summer holiday, and it's good. But fundamentally, they're not investing in the kind of things that would be enduring through the year. So I think there's a general caution and there's a bit of fear still in the society. But when you've had a crisis like this, what it's exposed is actually quite useful to the government potentially. I think there could be some fiscal restructuring, perhaps the manner in which the provinces are funded, not pushing them to resort to real estate projects to earn money to maintain and develop their areas. I think there's a whole piece around that the government could consider and restructure, which would unlock a lot more demand and I think would bring more stability. But overall, the problems are quite clear to the government. I think they're right not to have overstimulated in the first 6 months of this year, unlike the West. I mean, the West is now looking at China, and some observers are saying that the good years are over, that the semi-state free market system has proven to fail, and they're taking great pleasure in saying that. But actually, there's nothing like that happening here. If anything, I look at how much money has been spent to stimulate Europe, to stimulate the US economy, and it's a massive, massive debt load. China's not doing that. In a sense, because the government doesn't face election cycles, they're allowing the economy to pay its own way to recovery in some areas. I agree, though, that there will come a time, perhaps towards the end of the year, where they may need to stimulate more. So there's some restructuring that can be undertaken. A lot is now very obvious to the government that needs to be fixed. But I think we'll find as we go into the beginning of next year, there's real momentum and underlying demand and economic activity. I don't think there is anything very dangerous at the moment in the current situation.
Nothing so dangerous. Qu Qiang, back to you. Professor Gong mentioned about the job, the income. That's probably critically important in terms of increase aggregate the consumption here, the demand. Then, if you look at the unemployment situation, the overall situation remains stable. But for young people, 16 to 24-year-olds, that's where people have expressed a concern. Like the 21.3% last time, and then the government decided to suspend the release of the data while they will review the survey method. So how big a problem is that? And is there a silver bullet to solve that problem?
Oh yes, I think the job situation for young people can be a problem. Yes, we indeed are facing a lot of pressures. But I've been doing lots of investigations, especially field investigation recently in the past 1 or 2 months. I think the job market can be problematic, but not as serious as people imagined. I think one thing is that in the urban areas, still lots of the part-time job opportunities. So we've been seeing lots of students taking a gap year and falling into the temporary job market, doing an internship and finding the job with the cash flow. And also their parent generation actually providing a lot of support for the young people. For what I know is many urban young people after graduation, they choose not to go to work by themselves. Why is that? Because I think current job sentiment is not very good. They're not meeting their expectations, so they choose to stay at home. The parents is going to patronize and give them some support. So they stay at home, doing some examinations, preparation, so they can get into the government jobs, so they can get into the bigger companies. So they wouldn't mind to wait for another 1 or 2 years. So this shows on the numbers can be bad, but actually the situation can be not that bad. And also, if you go to the rural areas, if you go to the suburb areas, you find out the spending is still there. Young people are still one of the major forces in the urban spending, like we mentioned. You go to the movie theater, you go to the tourism resort. People are still spending the money. So I think that the cash pressure or the income pressure are still not conveying to the people who are seeking the job. So this looks like a little bit contradictory, but actually there kind of be some time lagging situation in there. So maybe when the economy gets recovered more in the second half of the year or early next year, especially when Federal Reserve just quitted the strong dollar policy, when the whole world demand has returned, the job market will flip back, and then more young people decided, okay, maybe it's time to get back into the job market. And because that time, maybe the job payment is better, level of the job are better. So that time we can see the data getting optimized.
Yeah. So, Qu Qiang, are you saying that this is in a sense temporary, and also in terms of the sentiment of the young people, it's not that bad. Let's say they are taking a wait and see attitudes to wait for bad opportunities for their job prospects. Maybe a couple of years later. So it's not as big a problem as it appears in terms of the number.
Oh yes, it's. The data can be, the truth can lay in just in between the data and observation. According to my observation, young people are not that desperate in the cash income, but the one with the job, with a stable job, according to the data, the middle-aged generation, for example, men or women about 35 or 40, they probably are riding Uber, driving an Uber. They probably are doing the delivery jobs. They have income. Actually, the cash payment is not that bad, but they are struggling in the break-even line. So they try to balance the expenditures and income in their family, and that can be the one who really needs some support. But the young people, they still have some support from the family and from the university, from the government.
Mm-hmm. Well, John, you mentioned about the package of stimulus, maybe from the government that's probably needed to help increase this demand there. But of course, you also mentioned about troubled sectors like a property market, like the Country Garden, Beijing, the largest developer in China, is facing a debt crisis. This happened 2 years after Evergrande, the group, defaulted. Is that a symbolic of this property sector? And if there is a stimulus package, will that also include support to the developers?
Well, I guess the point of advocating a stimulus package is to precisely address the issue of lack of aggregate demand. I mean, the unemployment, the youth unemployment issue we'll be just discussing. From an individual point of view, I understand it's not a pressing issue. I understand that youngsters have their support network. I think in today's China, the young people can afford stay at home. They can hang around for a little 1 month before they land a job or somewhere. But at a national aggregate level, that's cutting back economic development. That's cutting back aggregate demand. That's cutting back consumption, which feeds into less confidence in investment. So I want to make the point that yes, for individuals it's okay. It's not a problem. It's not something that's going to destroy their life. But it's a more of an aggregate problem for a national economy. It's not something to be overlooked. And the government's step in is not meant to just help these people. It's actually meant to help themselves, help with the economy. That's what I'm coming from. Now back to a question about the real estate market. I think what we are seeing at Hengda at Biguiyuan is just the beginning. It's just the tip of an iceberg, in my view. I mean, the real estate sector is a real problem because I think the trend has now reversed because of the population trend, as well as I think people's expectation with the urban real estate market prices. I think a lot of people don't see the prices of real estate properties still going up again anytime soon in these big cities and secondary, third tier cities as well. And that translates into reduction in demand. And of course, it have consequences for these real estate companies that have really stretched out and heavily in debt. So I think we face the danger of a slew of these real estate companies getting to financial problems, and the breakdown of their capital supply, the capital access, will impact other industries as well. For example, in the transportation industry, the construction industry. Now, let me give you one example. The city of Nantong, as I know it, I've talked to people over there, is famous for its construction business. A large part of the GDP of Nantong comes from the construction industry. These companies, they've been doing business in all over China, and actually beyond China as well, in other countries, building buildings essentially. And the financial crisis happening at the real estate companies will have the potential of spreading into its upstream, into the construction business. And that's going to affect a lot of people's jobs and other suppliers, vendors. So we need to be very careful about breaking this entire value chain. The whole system has the risk of being, falling apart if the government doesn't step in. So, I for one would advocate, the government seriously looking into the situation in Biguiyuan and see whether this company is still able to be rescued. At least not to let the problem at this company to be spreading out into other sectors, its upstream sectors. So that's the risk we are facing right now.
Well, David, of course, if you look at the other sectors, as we earlier mentioned, for example, these high-end industries like this say manufacturing of aerospace equipment in large-scale industries grew by over 20% in July. And if you look at the Chinese EVs, their export, their manufacturing, these numbers are very strong. Again, a mixed picture in some sectors, like this property sector, youth unemployment, there are challenges. And other sectors, you do see, actually robust growth expansion there.
Yes, I think the tech sector is very interesting. We have clients in robotics, and it goes from handling logs, timber at ports, through to the horticultural sector, where robotic applications are increasingly being applied. One of the things that I think a lot of observers are not giving enough attention to is the agricultural revolution of the last decade, definitely, but the ongoing change in China's farming practices and rapid move to efficiency and scale, and the technology being applied from everything from growing cherries through to the vast apple orchards out in Xinjiang and Gansu. It's an immensely efficient industry. And I think we're looking at a beginning of a period where a massive export boom out of China of these, many of them premium food crops, is something worth following. And because of the fact that there are fewer people on the countryside, and certainly because of the education system in China, there's been a real change to the fact that most farmers' children end up sitting in front of a screen doing a job in a company somewhere. They're not working in the field. So again, automation, robotics becomes quite a need in the agricultural sector. All these things are delivering growth. You know, we spend a lot of time in third and fourth tier cities, and we're really impressed with the level of local activity. And also there's a phenomenon in some provinces, Guizhou is an example, where local officials are seconded to lead commercial companies. And they're ranked by what happens to a set of 20 households in a county and whether they can increase the common wealth of those households. And as a project in some of China's poorest counties, this is working very efficiently. And I think people don't realize the relationship between business and government here is genuinely one of true partnership, and it can be very positive. So the government's quite good at picking the future, and as they are with technology, investing in the future. And as to real estate, I don't believe that this government has been surprised by Country Garden's dilemma. Evergrande was the warning, and using the managed insolvency process that at all levels China normally applies to bankruptcies, Evergrande has been gradually broken down, and some good assets have been hived off and are performing all right. The weakest people connected, the workers, the retired people with pension plans have been looked after. They will do the same with Country Garden. And I think it is the tip of an iceberg, as John said. There's probably 4 more, maybe even more, companies of scale in the real estate sector that will have to be semi-collapsed or changed. And at the end of this, we'll have a more competitive and a far less risky real estate sector. But there's at least 18 months, maybe 2 years of pain ahead of us.
Mm-hmm. Well, yeah, 2 years, pain ahead of us. Qu Qiang, it's this, this probably that's closer to the reality or the real picture of the Chinese economy. The government on one hand is successfully managing the development of the high-end industries, manufacturing, very successful. On the other hand, they are dealing with the potential challenges in some sectors, some of the sectors like the property, development there. So going ahead, people would say this is temporary. It's a transitioning, to the new growth drivers, high-end, innovation, instead of relying on this traditional investment in the real estate, in the infrastructure. During this process, obviously there are challenges. Given this international situation, it's becoming more difficult probably to handle.
Oh, yes. Definitely, we are seeing some similarities in development paths. If you remember, in the 1980s, Japan used to be the mass producers of the labor-intensive products, like China used to do like in the past 10 or 20 years, right? But in the 1980s, when America started to get into a stagflation situation, when Paul Volcker started to raise the interest rate to more than 20% a year, Japan shifted gears as well as China. What they're doing right now is Japan tried to cut off low-end products. They try to focus on the high-end automobiles, very accurate, mechanics, electronics. So that time, made in Japan just topped what's made in America, become #1 in the whole world. We all remember that period of time, right? So that is the shifting gears. Well, very funny is that Germany used to share the same development path. South Korea, the same. Germany did that phase probably in the 1970s. Korea at the end of the 1990s and early 2000s They all need that phase. So when the economy want to shift gear and provide better services, public services and products to their domestic citizens, they need to do that. Otherwise, they're going to trap the middle income level. So China is actually going through a very similar pattern. But a lot of people say if China is going to face similar difficulties like Japan or South Korea, I don't think so. Number one reason, China is a much, much bigger economy. So within itself, we can have domestic circulation. We are a whole system ourselves. And secondly, China is very, very sovereign, independent. We have our own say in the global issues. And thirdly is that China is a very large country with huge territory and population, so that we can create some other systems within ourselves. That is the reason why central government mentioned about the double circulation that actually can be working for an economy like China. Might not be working for Japan and South Korea, but it's working for European Union led by France and Germany, right? So actually, China is walking in a very unique road towards its own destination. It's what we call Chinese-style modernization. So I think it's doable, it's achievable, and I'm very confident about it.
Mm-hmm. Well, John, of course, there are concerns like China will become another Japan, with a long-term deflation problem over there of the economy. So, what do you make of that? What's your opinion on that? The differences and similarities there?
I think I would make the analogy to Japan in the sense that China is rapidly becoming like a developed country. I think the kind of a growth numbers we've been used to, 6-7%, is probably behind us for good. We are rapidly entering into an era where low single-digit growth figure is the norm as being among the world of developed countries. I think we probably see more figures like 5%, even 4% growth figures. Now this brings a whole set of challenges. I think our entire growth model needs to adjust to this new age. China's economy is relying more on productivity improvement, more on innovation, more on moving up the value chain, stressing the importance of high-end manufacturing, these kind of things. Because otherwise, it's very difficult to achieve the kind of growth figures we're looking for, given such a large base, just based on the old way of growth. That's based on investment, right? And that's not going to be enough. So, we understand that we're entering into this era. The question is that whether Chinese society, Chinese companies can answer to these challenges, whether they can move on to the higher value chain, whether they can innovate and move on to more sophisticated, higher value manufacturing. The example you raised, the automobile industry, is actually a pretty good example. Now, I think that we're doing very well in the auto sector. The Chinese cars are doing very well, especially electric cars around the world. But the cautionary note I would provide for that sector is that auto industry is very geopolitical. It's a strategic industry because it involves a very long value chain. It involves a lot of employment. It's going to be a political problem. And think about this. I mean, our relationship with Germany is very much anchored on this one-way flow of auto cars and auto technologies from Germany to China. Now, think about the day when this trend is reversed. And I would back to, ask this question that whether it has any political implications for the two countries' relationship.
Yeah,
so, that's a big concern from my perspective.
Well, probably the key to that is a fair competition. With that, we come to the end of today's show. Many thanks to our guests. You can also find us on the CGTN app on our YouTube. Thank you for being with us. I'm Qu Qiang. See you next time.